Hi students, in this video we are going to see a 50-mark question which is on risk management. It's completely on risk management. It's in the specimen paper for 24-25 syllabus. Let's take some time, read and understand the question first, and then we'll start answering it. The following exhibits available on the left hand side of the screen provide information relevant to the question. First one, Northern Company Group. Second one, Intra-group netting, currency futures hedging, interest rate collars, new subsidiary. The information should be used to answer the question requirements within your chosen response options. You know, when you open the question, this is what you see. Then there will be these 5 exhibits and the requirements. Let me have a look at the requirements. Prepare a report for the board which, alright, they want a report, and the report has 6 sections, 1, 2, 3, 4, 5, 6. There are 6 requirements that need to be included in the report. First one discusses the issues affecting the establishment of the group treasury function in Europe and the impact upon treasury activities relating to the European subsidiaries and the American parent company. Some discussion, 6 marks. Calculate the impact of undertaking intra-group settlement between Northern Company and the 3 subsidiary companies using a tabular format. The intra-group settlement cash flows for the 4 group companies, 7 marks. Intra-group netting, you know, this is one of the methods of internal hedging that we use for currency risk management. Intra-group netting or intra-group settlement, 7 marks they are asking the calculation of that. Demonstrates how the transaction with the Japanese customer would be hedged on the basis of the information supplied and what the result of the hedge would be. Some hedging method is going to be mentioned in the question. 5 marks. I don't think it will be more than one method. There must be one method, either futures, options, something is going to be there. Let's see that. Demonstrate how the short-term investment would be hedged on the basis of the information supplied and what the result of the hedge would be if interest rates rose or fell by 0.5%. Interest rate hedging, 8 marks based on the information given. So there is going to be some information. Let's see. So if you look at 2, 3, 4, these are mostly calculations. 7 marks, 5 marks, 8 marks. That is 20 marks are on calculations. Explains why the treasury function might have decided to use currency futures and an interest rate collar as the hedging methods 3 and 4. So we need to explain the reasons why out of all the methods these 2 would have been selected. Basically the advantages of these 2 we will have to mention. Assesses the political and operational risks which may affect the new subsidiary currently under consideration. 10 marks discussion. We have to thoroughly analyze, assess the political and operational risk. Professional marks are awarded. Okay. Now let's read the exhibits one by one. Northern Company is a commercial vehicle manufacturer based in the United States. It has currently enhanced the use of automation and information technology in its operations. The reliability of its vehicles is high due to the strict quality control procedures which it enforces. Northern Company has its head office and group functions such as treasury and internal audit are based in the United States. However, over time, Northern Company has established a number of subsidiaries in Europe which carry out production and sales activities. I Company in UK, F Company, Eurozone, P Company, Denmark. North Company is looking to expand its presence beyond North America and Europe, and its sales outside these continents are increasing. Treasury function. Northern's group treasury function is involved in setting the group's overall financial objectives. It provides currency and interest rate risk management and corporate finance services for the group as a whole, and also deals with the treasury activities of the parent company. The group treasury function is currently based at the head office in the United States and overseen by the group finance director. Staff work full-time in the group treasury function office. In addition, each subsidiary has its own treasury function responsible primarily for liquidity and funding management. Because more of the Nothni company group's activity is taking place in Europe, the group finance director has made a proposal to relocate the group treasury function to Europe. A separate treasury function would be established in the United States, responsible for the liquidity and funding management of the parent company. Treasury activities. In order to increase the director's understanding of treasury activities, a report is to be prepared which will include an appendix giving examples of intra-group netting between Nothni company and its subsidiaries, hedging foreign exchange risk using currency futures, hedging interest rate risk using a collar, together with an explanation of why futures and collars will have been chosen to hedge the transactions concerned. Alright, so all that is in the first exhibit. So they are explaining how the treasury is functioning now and why they want to shift it to Europe. The first part of the question was regarding this, the issues related to shifting the treasury function, as well as how it will affect the subsidiaries' ongoing treasury activities. We can discuss that. Let's see. Now exhibit 2, intra-group netting. Intra-group netting. Cash flows between Nothni company group of companies are managed through intra-group netting using the USD as the base currency and spot mid rates. Okay, spot mid rates. The following cash flows are owed to and owed by Nothni company and its subsidiary companies. Owed by, owed to, and the amount in millions of respective currencies. Spot mid rates are currently as follows. Settlement will be made in the order that the company owing the largest amount in USD will settle first, with the company owed the smallest amount in USD. That should be simple. We will see when we start the calculations. Third exhibit. Currency futures hedging. It's now 1st of September 2024. A Japanese company owes Nothni company Japan yen 925 million for a sale which has just been agreed. Settlement of the contract is due on 1st of May 2025. The group treasury function decided to use futures to hedge this amount. Exchange rate, spot rate is given. Currency futures, 4 different futures are given. Futures contracts mature at the month's end. Basis can be assumed to diminish to zero at contract maturity at a constant rate. That's the usual assumption based on monthly time intervals. It is also assumed that there is no basis risk and there are no margin requirements. Interest rate collars. It is now 1st of September 2024. On 1st of February 2025, Nothni company is due to receive an amount of USD 54 million, which it plans to invest until the funds are likely to be needed on 1st of August. The current base rate in United States is 3.25%, but predictions in the media suggest it could rise or fall by 0.5% by 1st of Feb. Nothni company can currently invest funds at a floating rate of base rate minus 30 basis points. The group treasury function decided to use a collar on options. Collar on options on interest rate futures to hedge the interest rate risk. Okay, so they are going to use collars. Options on 3-month March USD futures, strike price, call option, put option given. The current 3-month USD futures price is 96.54. Futures and options contracts are assumed to be settled at the end of each month. Basis is assumed to diminish to 0 at contract maturity at a constant rate. Same points, no basis risk, no margin requirements. The last exhibit, Nothni company is considering setting up its first subsidiary with sales and production facilities outside the United States and Europe. The group finance director has suggested a country in which the subsidiary could be based. The country has low corporate tax rates, which are sustained by increasing level of government borrowing. It also has limited employment and workplace regulation. It does, however, have regulations relating to the workforce of subsidiaries of foreign parent companies. At least 75% of employees of these companies must be home country citizens. The country recently decided not to join a regional free trade area which neighboring countries have established. It is currently in dispute with the regional free trade area over the regulations applied to imports into the trading area from external countries. One reason for establishing a subsidiary in this country is the demand in the region for robust commercial vehicles of the type which Nothni company manufactures. These are needed to cope with the increasingly changeable weather, including more frequent floods. So that's about the new subsidiary. The last requirement was to analyze the political and operational risks regarding this subsidiary, so for which we are going to take information from here. Cool. So we need to write a report. Let me finish all the calculations before I start the writing part. So calculations, if you look at the requirement, second part of the report is about the netting, intra-group netting. All right, let me take these numbers and copy it to Excel. Out by to right, this is the information given. Let me just have it on the sides. Then we will make a table. How are we going to make the table? First thing, I need to convert these values to dollars using the mid rates. Mid rates are also given. Let me copy that also here, mid rates. So we have to use these mid rates and convert them to dollars. Let's do that first. So to convert it, let me have the table as it is here. Out by, out to, and the currency. Let's keep it here. Let's have headings. Let's call it Annexure 1. Annexure 1. This is about intra-group netting. Right. Let's convert this to dollars, dollar millions. GBP, the rate is given. 1 USD is 0.83 0.8320 GBP. So it's going to be 16.40 divided by 0.8320. That many dollars. Next one, euros here. So 37.42 divided by 0.9627. 40.75 divided by 0.9627. 82.12 divided by 7.2107. 56.98 divided by GBP 8320. 72.68 divided by 7.2107. 27.29 divided by USD rates. So that's USD itself, 27.29. 73.79 divided by, that's euro, 0.9627. Let's double check. Here, I divided by 0.832. 0.832 is GBP, correct. This is divided by 9627, euro, correct. Again, euro, correct. Divided by 7.2, yes. Divided by 0.832, GBP, correct. Divided by 7.210, DKK, correct. This is USD itself. This is last one, 0.9627, right. Now we'll make a table. How do we make a table? Out by, let me erase this, I don't need this now. O2. O2, I will copy these names. 1, 2, 3, 4. Same 4 names will come here again. Right. All right, one by one, let's fill it. First one, owed by Nothni company. So I have to fill in this column. To which company? Iptop company. Here, Nothni, Iptop, this one. I can round these numbers. We'll keep it in 2 decimals. Right, looks better. Second one, Nothni, owed by Nothni to F company. To F company. In this column, F company, last one. Amount, this. Third one, owed by I company, here in this column. To which company? F company. All right, F company. I to P, 11.38, I to P. F to I, F to I, here, F to I, 68. F to P, 10.07, F to P, 10.07. P to N, P to N, this figure. P to F, this figure. All right, let's get the total. Equal sum the row. Do that column wise also. Each column get the total. Total. Right. Then now see, I company, it owes 53.72 altogether, owed by I company 53.72, and to I company, owed to I company 88.20. So let's subtract it here. 12 minus this figure. P company, how much it is to receive? P company 21.47. 27.29. 157.85. Get the net amount. That's the net amount. But I made a small mistake here. O2 should have been positive. Out by should have been negative, because if you look at I company, they have to pay 53 and they are going to receive 88. Whereas I have given the signs wrong. So what we will do, remove this minus here. Remove the minus. O2 must be positive. Then we will redo the calculation. Amount to be received minus amount to be paid. Amount to be received 88, but they have to pay 53. So net receipt is this. Good. So let's say net receipt or payment. Payment I am writing in brackets. So basically P company has to pay 82.47. N company has to pay this much. Right. Now what do they say? They have given the instruction. What do they say? Settlement will be made in the order that the company owing the largest amount in USD will settle first, with the company owed to the smallest amount. So let's see who is owing the largest amount. This company. They have to pay first. To whom will they pay first? For the smallest amount. So they will pay here 82, they will pay 34 here. Then balance will be 48 something. Still that is the biggest amount. Then they will go and pay that to this company. First pay here, then here. Finally, this company will pay here. That's the plan. Once again, see, the company owing the largest amount will pay to the company that is to receive the smallest amount. See, made in the order. The company owing the largest amount in USD will settle first the company owed the smallest amount. So let's say Pamber company pays Pamber company to Ipthop company. How much they have to pay? This amount, $34.48 million. Then how much will be the balance? Let's do a check here. 82.47 minus 34.48. How much is that? 47.99 is still there. Where are they going to pay that? To F company. Pamber to F company. F is Flexcomb. $47.99. Finally, Nothni company to Flex company. Nothni company to Flex company. How much is it? The full amount, 31.29. Just add these two and see whether it adds up to 79.28. Yes, 79.28. So their full amount will be settled. So let's say net or final settlements. Final settlements will be like this. Clear? This is what we call intra-group netting. This is in dollar millions. Final settlements as follows in dollar millions. They didn't ask here, but you know why we are doing that. Otherwise, they have to do several transactions. Many transactions they have to do. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 transactions, or no, 8 transactions they would have done. 8 transactions, the amount would have been bigger. Number of transactions is high. So you will be bearing high bank charges. The transaction costs would have been high. To avoid that, we do intra-group netting. So a couple of things you need to remember. To do this, the respective countries' governments should allow it. If the governments have a policy protecting their banks or in favorable to their banks, they may not allow intra-group netting. So you must be aware of these factors when you are doing intra-group netting. However, in this question, it was about calculate. This is it. 7 marks, isn't it? Where is the requirement? 7 marks. Good. That's an easy 7 marks. Third part, demonstrate how the transaction. See, I didn't answer the first part. I'm finishing the calculations in the spreadsheet. Then we will go to the word processor and start writing the report. So 1 is discussion only in the report. 2 is calculation. I finished it in the annexure. Demonstrates how the transaction with the Japanese customer would be hedged on the basis of information supplied. So I remember they were mentioning, they said they are going to use futures contracts to hedge the foreign currency risk. Let's go there. This scenario, currency futures hedging. Currency futures hedging, it's now 1st of September, right? And they want, they are receiving something in 1st of May. So definitely it has to be June futures. June futures. All right, let's start our calculations. Annexure 2. Let's say annexure 2. Let me change this font. Let's make it Arial or something. Better. Right. Annexure 2. It's going to be futures hedging. Right. We need to see which futures. So the settlement is in May, therefore June futures will be useful. June, or let's say now let's have an analysis to find whether they should buy the futures or sell the futures. See here, they are receiving Japan yen. The futures currency is Japan yen, 12.5 million. So once again, understand this company is in US. They are receiving JPY. So what they have to do, they want to sell JPY because they don't want to keep the yens. Their currency is dollar. Their currency is dollar. When they receive yen, they have to sell yens. So how do they set up the futures? So let's put it this way. Sell June futures. They will initially sell the June futures and buy it to hedge the to start the hedging, or to open the hedging, to initiate hedging. What do? They should sell the futures. That means now what they should do, whatever the date today, now sell futures. And on that settlement day, 31st of May, they have to buy it back. This is what they have to do in order to hedge their position in this particular transaction. All that why it is so and all the fully detailed explanation I have done in the class. Whoever have watched my videos or whoever have learned with me would know the reason behind that. However, to answer the exam question, simple, very simple. See, JPY is the currency of futures. Futures currency is JPY. How do I know? Size is given like that. See, contract size is Japan yen 12.5. Right. So on the transaction day, when you receive Japan yen, what do you want to do? You want to sell the Japan yens, selling it, which means the futures now you must sell and buy it later. Done. Then we will find the number of contracts. It's very easy this time because the transaction is also in yen Contract currency is in yen, simply divide it. 925 million yen is the transaction amount, 12.5 million yen is the size of the contract, divide it. 925 divided by 12.5. 74 contracts. I believe this is a whole number. There is no over hedging, under hedging. Yes, exactly 74 contracts. No over hedging, no under hedging, exactly 74. Very easy question. Those who have watched my last video will know we had a scenario where we had to do over hedging, under hedging in one scenario, over hedging in another scenario. So we used forward contracts for that over hedged, under hedged amount. Here nothing such is required. Exactly 74 contracts are required. Done. Now we will do the basis calculation. The transaction is happening 1st of May, not 31st of May. Here I said 31st of May, must be 1st of May. Let me change this. 1st of May. Right. So what's the date today? 1st of September. Then we need 1st of May 2025. Then you take 30th of June 2025 as well. Spot minus futures is the basis. Spot rate, futures price, difference is basis. Spot rate 1st of September, here 0.007398. Futures price, June futures 007538. So the basis is this much. They have given it in 6 decimals. Spot rate and this one are given in 6 decimals. So we can do the working in 6 decimals, not more than 6. Right. You know, on 30th of June is the maturity of this futures. Basis must be 0. Calculate the number of months 1st of September to 30th of June. September, October, November, December. September, October, November, December. 4 months in 2024 and 6 months here. It's altogether 10 months. On this date, how many months are unexpired? May and June. 2 months are unexpired. So your unexpired basis is going to be this figure divided by 10 multiplied by 2. 2 months are still remaining. Six decimals you can have 0028. That is the unexpired basis minus figure 0.000028. You don't necessarily have to make this table, but the table makes it error free. Now I can take futures lock-in rate. Lock-in rate. How do we find that? Just to recall the formula. Opening futures price plus unexpired basis. Opening futures price means this one. Unexpired basis is this one. Six decimals will take. Yeah. So this is the futures lock-in rate. That means the effective rate is going to be this. Effective rate. You know, when it comes to futures, how futures works, the transaction amount will be exchanged in the spot market. Separately, you do trading on futures, you make gain or loss on futures. Suppose if the spot market transaction gives you a loss, futures trading will give you a gain and it will almost balance that loss. Similarly, in the spot market, if you are having a gain, futures will make a loss, it will balance it. However, to find the final outcome, what we do, we use this lock-in rate and do the exchange. So what's going to happen now? 74 contracts are there, right? This is the company, Northern company. Let's say this is the counterparty. What we can assume, effectively what's going to happen, for each contract, this company will give Japan yen 12.5. The counterparty will give back dollars. At what rate? at this effective rate. So 12.5 Japan yen multiplied by 0.007510 would be the amount of dollars counterparty will give. This is not the real transaction, again I am repeating, but effectively this is how you are going to assume it. So amount to be received in dollars, 12.5 million multiplied by this exchange rate. This is for one contract. You have 74 such contracts, dollar millions. So effectively you are going to receive $6.95 million. Amount to be received $6.95. That will be the final outcome by futures. Right. Now let's go to the third calculation. Once the third calculation is over, we can go to the report part, Annexure 3. What is Annexure 3? About interest rate collar. It's now 1st of September. On 1st of February 2015, Nodni company is due to receive an amount of this much. So they want to invest. See, they receive this amount on 1st of February, but they need this again in 1st of August. So they want to invest. So let me write that first. The company needs to invest 54 million from 1st Feb to 1st Feb to 1st of August. 1st of August. So if they want to do hedging using interest rate futures, investor, right? So they need a call option. Call option, investor, remember, just the futures only. If it is futures only, interest rate futures, what do? Investor needs a call option. And borrower, if you are going to borrow, you need a put option. Why so and all that, we know the details. We have already studied in the theory why a call option or how a call option protects the investor, how a put option protects the borrower. But now for the exam, just remember this point. Interest rate futures, investor needs a call option, borrower needs a put option. And if it is a collar with this, remember, if it is a collar, what investor should do, you obtain a call option, you basically buy a call option and do the opposite, sell a put option. Sell a put option. This will be the collar. Whereas borrower, already we said he has to obtain a put option. Obtain a put and sell a call. This is what the collar will be. The main reason why we do this is to reduce the premium cost to us. By selling another option, we will be receiving some premium that will nullify or that will at least minimize this premium. Cool. So going back here, this is an investor. He need to buy a call option and sell a put option. Which month? 1st of February is the borrowing starts or investment starts. So March options. Check, they have given March options. Yes. So there is no need for us to choose anything. We can just write it. Company needs to buy March call options and sell March put options. Right. Number of contracts. Number of contracts 54 million. Let's do this. First amount 54 million divided by, let me write it and show it to you first. See, amount to be invested or borrowed divided by contract size, this is one. Then the term for which you want to invest or borrow divided by the contract term. and you do all of them. So let's do part by part. Amount is 54 million divided by contract size $1 million. $1 million multiplied by, for how long you want to invest this, starting from Feb, March, April, May, June, July. August is not counted because 1st of August you need it back. 6 months. 6 months. Once again see Feb, March, April, May, June, July. Divided by, contract is for how many months? 3-month futures. Can you see 3-month options? Divide by 3. So you need 108 contracts. 108 contracts. March contracts. Okay. Now we need to decide on the expiry day, that means on the, not expiry day, on 1st of August, when you want to close your position on options, will these options be exercised or not? So let's write call option, put option. Write the exercise price, strike price rather. Call option, what's the strike price they have given? 0.492. No, those are premiums. Those are premiums. 97, 96.25. 97.00, 96.25. Call option and put option. Right. And we'll estimate the price on that date. So to estimate the price, current futures price is given. Spot rate was given somewhere earlier. Here the current base rate is 3.25. All right, let's find it. So let me do a working here. Spot rate 3.25 means 100 minus 3.25, 96.75. And the futures price, $96.54. Basis $0.21. That's the basis. This is when today. What is the date today? 1st of September. Right. 1st of Feb we are closing it. 31st of March the basis has to be 0. So count the number of months. September to March altogether. September, October, November, December, Jan, Feb, March. 7 months. Feb and March, 2 months are outstanding. So 0.21 divided by 7 multiplied by 2. Unexpired basis. Unexpired basis for 2 months will be 0.06. Unexpired basis. So the exercise price is already given. I need the futures price on this date. Futures price will be, I have to take 2 cases. Case 1, if the interest rate increases by 0.25%. If interest, not 0.25, 0.5. Interest rate increases by 0.5%. Then this futures price will be or rather spot rate will be let's say spot rate wait, now we took 3.25%, isn't it? 3.25. If it increases by 0.5, 3.75 is going to be. So 100 minus 3.75, 96.25. That means this place will be 96.25. So futures price has to be the difference of these two, right? So futures price will be this minus this, isn't it? 96.19. So let me say futures price will be 96.25 minus 0.06. Same thing, if interest rate falls by 0.5 percentage, then 3.25 will become 2.75. So it's going to be 100 minus 2.75, and this working is same, but this minus 0.06, 97.19. Am I clear? So for each case we have to do it. Let me erase this here, right? Because there are two cases, I am taking one by one. This can be 96.25 or it can be 97.25 depending on two scenarios, right? So let me take this working down here. Okay, in this scenario, futures price, call option futures price 96.19, same here 96.19. I need to decide whether it will be exercised or not. We'll take this later, we'll keep it here. See, call option means this is the strike price, is the buy price, closing price will be the selling price. Call option means initial transaction is buy. So buy 97, sell 96.19. No, it doesn't make profit for you. It will not be exercised. This one, put option. Put option means initial price is sell price. This is sell 96.25, sell 96.19, buy. Yes, it makes profit. So this will be exercised. So call option is with you. Put option is with the counterparty. So in this case, counterparty will decide, yes, they will exercise this option. So you're going to bear a cost here. What will be the transactions? Let's see. The return, deposit return or investment return, 54 million you are investing. Here we assume spot rate is 96.25. That means 3.75 percentage. They can borrow at didn't they say here currently invest funds at floating rate minus 30 basis points. The floating rate minus 30. Floating rate is 3.75 percentage minus 0.3. 30 basis points means 0.3. Right, this will be the investment rate for 6 months. You are investing for 6 months. This is the return from the investment, 0.1. Then let's adjust for premiums. Premium, call option. You need 108 options, 0.492 percentage. 1 million, 0.492. See, 1 million, 0.492 percentage. That's annual percentage, 6 by 12. This is the premium for one contract. Such 108 contracts you have. Minus it will be, you are paying. But the put option premium you will be receiving. So let's say premium put option. Why? You sold it. Premium put option again 0.356. So 1 million, 0.356 percentage into 6 by 12. This is one contract's premium that you are going to receive. 108 contracts like that. Premium. Done. Then put option is going to be exercised. Now think logically, interest rate has increased. As an investor, you must be happy. You don't have to protect yourself. That's why the call option need not be exercised. But who would have bought this put option? And a borrower would have bought this put option. For the borrower, interest rates going up is adverse. So to protect him, he will be exercising this put option. So what is the amount you have to pay? So let's say loss on put option. This minus this. That's the rate that you are losing. that will be 3.75 and 3 point some percentage divided by 100 to make it percentage into 1 million into 6 by 12. Why, these are all annual rates, but our requirement is only for 6 months. So 6 by 12. This is the loss on each contract, 108 contracts. So net investment return or net return sum of all this. I can give it as a percentage, net return percentage. This amount is a 6 months return, multiply by 12 by 6 to get the annual return, and then the whole amount you divide by 54 million. So effectively 3.058 percentage comes as the net return to you. Alright, I made a small mistake here. Investment return is okay. Premium on call options, let's see how I did that. 1 into 0.492, that is also okay. This is okay. But this one, if I am multiplying by the number of contracts, I should take for one contract. One contract, what did I do? 1 million is the contract size. 0.492 percentage is the contract, the premium percentage, and it is a 3-month contract. Doesn't matter, I am investing for 6 months, contract size is 3 months. So, let me put a bracket here to explain once again. Look at this. This is the premium for one contract. Contract size, percentage, and the contract duration 3 months. The investment duration is different, which is already factored in this calculation. 108 already factored for that. Remember, when we were calculating this, we multiplied by 6 by 3. So that calculated it. Do the same adjustment for all of them. I just missed that point. 3 by 12. Right. So this again, this bracket is the premium for one option. Right. Loss when you are calculating. Loss. What you could have done, if this is confusing to you, you can get this difference. See, 25, 19, 6 is the difference, isn't it? Let's say loss. Six is the difference. So, loss, let me recalculate. 0.06 percentage is the loss. One contract is 1 million, 3 by 12. This is one contract times 108. That will be the loss. So net return is this much. Let's quickly do that for the other case. If interest rate falls by 0.5 percentage, let's take this. Strike price is same. Futures price I have to recalculate. Where did I recalculate? Here. Futures price will be we already had it correctly, 97.19. This figure will come in here. Right. Now call option means initial buy, this is sell, this will be exercised. Here this is sell, this is buy price is higher, that will not be exercised. So you will have a gain. Think logically, interest rate goes down, it falls by 0.5. Who needs to be protected? Investor. So investor will exercise it. Borrower will be happy the interest rates have gone down, he doesn't have to protect himself. Right. How much is the gain? This minus this. Okay. Again, let's do all these calculations. Investment return. No different in that. That will change. Why that will change? Not 3.75 percentage. It's going to be 2.75 percentage. That's the investment return. Premium is same. Loss on put option. There is no loss on put option this time. It's going to be gain on gain on call option. Gain on call option, how much? 0.19 percentage. So 1 million, 0.19 percentage, 3 by 12. This is the gain on one contract, 108 contracts gain. Right. So let's see once again, investment return is this, and then premium on call option is this, premium on put option is this, gain on call option is this. All right. So that will be the scenario. So this tells us, however interest rate falls, your net return will not go below 2.5%. Similarly, if interest rate goes up, your return will be limited at 3.25%. So minimum is 2.5, maximum is 3.25. That's all about collars. Done. We have done all three calculations. What are the three calculations we did? First one was about intra-group netting. Second one was about futures hedging for currency risk. Third one is interest rate collar. So out of 6 requirements, 3 requirements we have answered in the annexures. Now let's go to the word processor to start writing the report. So this video is going to be a little lengthy, because it's a 50-mark question. I'm doing not only the calculation, I'm going to do the report part as well. So it might be a bit lengthy. Take your time, slowly go through this. Let's go to the word processor. All right. Now the calculations being done, let's go to the report. So you can see the requirements once again. Second part, third part, fourth part. We have done all these 3 calculations. 1, 5 and 6 are discussions which we'll have to elaborate in the report. All right, let's go to the report. I'm not going to write the report in full, but I'll tell you what structures you have to follow, what important points you're going to include here. You can have a heading report, right, to the board of directors, Northney Company, from if the question doesn't mention what your position is, you can say external consultant, right? Date, whatever the date, exam date, you're going to say, right? Subject. What are the main points here? If you look at the requirements, you will get an idea about the subjects. Subjects are going to be, see, mainly we are discussing about the treasury function, shifting the treasury function, risk management, and the proposed new subsidiary. So let's say relocation of the treasury function, risk management, and the proposed subsidiary. Okay, give a suitable subject. Then somebody asked me in the previous videos, what headings to include. Usually reports, definitely first heading has to be introduction, and the last heading will be conclusion. Brief paragraphs. Introduction is just summarizing the requirements. So whatever you are going to discuss in these 6 points, give it in a brief paragraph, right? That's introduction. And almost similar thing at the conclusion also. This report has analyzed this and this, this and this, this and this. Suppose if there is a clear recommendation to be given, like if it is an investment appraisal or something, if you have to give accept, reject recommendation, you can include that in the conclusion as well. Apart from introduction and conclusion, then what we do, 6 headings I'm going to have here. 1 about this one, 2 about this one, 3, 4, 5, 6. Right? Introduction. So introduction, this report discusses what? What is the first one? The issues affecting the establishment of blah blah blah. Okay. So let's say the report discusses the issues related to the relocation of group treasury function from or to Europe. Okay, that covers the first requirement. And then second, third, fourth are some examples of risk management techniques applied. So it also analyzes some examples of risk management techniques used by Northney Company. Right. That covers 2, 3, 4. 5 is about, okay, so that is again connected to that one only, like why they are using futures and collars. Political risk, okay, last one. Further, the risks associated with the proposed new subsidiary are also analyzed, are discussed. Right, so see, introduction is very simple. You are just rewording the requirements in a brief way, just to give an idea to the reader what is going to follow in the report. Done. Now we will go one by one. First one. What is the first one? Issues affecting the establishment of the group treasury function and the impact upon treasury activities relating to the European subsidiaries and the American parent company. Okay. So let me have a heading, relocation of the group treasury function. Right. So what are the issues you think we have here? Few of the issues I'll just jot down. You have to put it in proper wordings. First one we can mention here. Right now, most of your treasury function the group treasury function is based in America. So when you shift Europe, see, Europe had many divisions, a few divisions, and each division had a treasury function, like divisional treasury function. Now you have to make a decision whether to upgrade a divisional treasury to group treasury. You are going to upgrade a divisional treasury to group treasury, or start from scratch. This you will have to decide. Maybe one of those divisions treasury, you can upgrade it. You can change the structure and say, so that treasury will function as the group treasury. So you have to do some recruitments for that, and you have to redesign your group structure or the treasury structure, and then go ahead with that. If not, complete it from the scratch. So this is one decision you have to take. Second one, whichever the case, those who are working in the group treasury now, who are based in America, will have to be transferred to Europe. So how far that is feasible, shifting of personnel, right? Either they are going to shift physically, or else they have to start working remote. Because now they say all the staff, they are working from office. So once you shift the group treasury to another country, are you going to shift these people there, or are you going to start working remote? If it is working remote, how far it will be feasible, whether the company has experience in doing that, we need to check. Second point. Third point, if you are shifting also in the new country where you're going to have the group structure, group treasury, these people who are shifting, can they manage? Because there will be difference in language, difference in culture. So whether the staff can shift to the new location and whether they can manage. Discuss about all these points as the common issues, general issues. Then also the question asks you something specific. What are they asked? And the impact upon treasury activities relating to the European subsidiary and the American subsidiary, American company. Okay. So the other functions, that is European ones, now what will happen to them? Because see, Europe, there are 3 subsidiaries they have. This is in one country, this is in another country, this is in another country. Let's say now this is the country where you are going to have the group treasury. Now you need to decide what to do with the treasury of this division, because earlier this division might have had a treasury function with certain autonomies and all, because the group treasury was in another continent. Now the group treasury is coming to the same continent, so they can work more closely with these departments or with these divisions. So do we have to rethink the autonomies, the powers we have given to each of these divisional treasuries? But when doing that, if we are going to reduce the powers of those treasury functions, we must make sure it doesn't affect the autonomy as well. It doesn't affect their motivation as well. Repeat. Now earlier the group treasury was in another continent, so the divisional treasuries might have had more autonomy, more power to make decisions. Now group treasury coming to Europe, you will have to rethink whether these divisional treasuries need the same powers that they had already. If you think no, when you are redesigning the structure, when you are redesigning the powers that they are going to have, we need to ensure their motivation is not affected. Include that here. What about American subsidiary or American operations? Now you need to have a separate divisional treasury for them. You need to have a separate divisional treasury for them, because the group treasury is no more in America. It has shifted to Europe. So we have to clearly define a divisional treasury, draw a boundary between this divisional treasury and the group treasury, and they must start working independently. So this might be the challenge that American American operations have. Explain these, not too much, because 6 marks. So if you explain these points, that would cover the 6 marks. So this heading is done with that. What is going to be the next point? Third point. Calculations, we have done it already. If at all, if you want, you can we can include a point. Examples of specific risk management techniques. Okay, then you can say annexure 1. Let's put it this way: the impact of intra-group netting is analyzed in, or not the impact, let's say the process of intra-group netting is described in annexure 1. What else we have? This one. The outcome of hedging the foreign currency or JPY receipt, Japan yen receipt, using currency futures is calculated in annexure 2. Next one, the interest rate risk related to a short-term investment has been analyzed in annexure 3. Done. So just briefly I am mentioning what and what. So that covers 2, 3, 4 finished. Now 5. These 3 these 2 we had to explain. 5. explain why the treasury function might have decided to use the currency futures and interest rate collar. So let's say the choice of hedging instruments, right? So here we have to justify what could have been the reasons. We don't know, they have not given here what the reasons are. So in general we are going to say, definitely when we make these decisions, the analysis about how much is the outcome, the amount, that would have been one key element when we were deciding it. Two, if you see, futures and interest rate collars both are exchange traded. Exchange traded has certain advantages. What advantages are there? Higher liquidity. Whenever you want, you can get rid of this, and easy to sell, easy to buy, higher liquidity, and low or almost no counterparty risk. You don't have counterparty risk because properly regulated by the Securities and Exchange Commissions. So you don't have to worry about whether the counterparty will default the payment. So those are general advantages. Also, now going specifically, futures, it's better than options. Why? No premium. Right? I'm just considering with the exchange trade options only. So it has. I'm not considering the other contracts and all, forward contracts and all, because looking at the exchange traded other instruments, futures is good because it doesn't have premium. Options have premium. Similarly, interest rate collar. What is the advantage of collar? See, if it is futures, interest rate futures, that just fixes the amount. You don't have a freedom. You don't really enjoy if the interest rates move favorably. But collars give you the advantage of, if you saw the calculation, see here, minimum 2.5, maximum 3.25. Within this range, it can fluctuate. So there is a small range that keeps it open for you to enjoy the benefits of favorable movements. So let's say this hedging, maximum 3.25%, minimum 2.5%, plus lower premium. Why lower premium? That's why the collar is, if you want to have a look at the calculations here, premium on put option, what you receive, call option, what you pay. So it reduces. If it is only the option, not collar, then this wouldn't have been there. Put option wouldn't have been there. So going for a collar, for a certain extent, it reduces the premium. Discuss about these points that will justify why the company might have gone for this futures and collars. Last one, 6-1, 10 marks. That's where you have to spend more time. Assess the political and operational risk which may affect the new subsidiary. Right, political risks. Let's say new subsidiary. Under that, A, political risks. Just let's go back and read that point once again, just to recall. New subsidiary. Considering setting up its first subsidiary with sales and production facilities outside US and Europe, the group finance director has suggested a country which could be based. The country has low corporate taxes which are sustained by an increasing level of government borrowing. It also has limited employment and workplace regulation. Oh, okay. See, those are operational risks. We will come to that. It does, however, have regulations relating to the workforce of subsidiaries of foreign parent companies. At least 75% of employees of these companies must be home country citizens. The country recently decided not to join a regional free trade area with which neighboring countries have established. It's currently in dispute with the regional free trade area. See, that's the political risk. One reason for establishing a subsidiary in this country is the demand in the region for robust commercial vehicles of the type which company manufactures. These are needed to cope with the increasingly changeable weather, including more frequent floods. Alright, so political risk. First one is very obvious. The relationship between this particular country that we are considering and rest of the countries in the region. Why am I worried about that? It's very obvious. Other countries, they have entered into a free trade zone agreement where this country is not part of it. Whereas we are going to establish this subsidiary mainly targeting the regional sales. So how is it possible? Imagine this is the particular country, this is the region, you are going to set up the subsidiary here. There is no good relationship between the region and this country. So setting up a subsidiary here, isn't it a disadvantage for you? What if there will be tariffs? What if there will be legal requirements? What if there will be bureaucracy? Increase the higher bureaucracy just, to reduce the imports from this country towards the region. So there must be challenges that company will have to face. So those are one type of political risks that company has to consider. Right? This can increase the tariffs. There can be legal issues or legal requirements. There can be bureaucracy issues. So what would have been the better solution? Rather than setting it up here, go to a country within this free trade zone and set it up there. Even though the country may not be as welcoming as this country, your sales would have been easy within the free trade zone. So highlight that point politically. Second one, I remember reading, they say the company has high borrowings. You know what happens with high borrowing countries. After some point, when they struggle to settle those borrowings and interest, when the interest becomes a significant burden, they will have to do some structural changes in their economy to face that interest burden. So what do they do for that? They increase the tax rates. Sorry for the interruption. Yes. So what they do? They increase the tax rates. Tax rates might increase. What's happening? All right. Coming back. So when the government has high borrowing, when they fall in trouble, what changes in structures they do in their economy? They may increase the tax rates. They may increase the interest rates. This might have adverse impacts on the business. Not only that, there might be regulations on remittance of funds. So if this company, after making profit, if they are not able to declare dividends, because when the country thinks of improving their economy, they might come up with regulations like that. They might say a certain percentage of earnings must be reinvested in the country itself for a certain number of years. So such regulations might affect the business. Also, let's see what else is there. This one maybe I can take under operational risk, having people from there. Now they have low corporate taxes. Okay. Yeah, so those could be the limitations, you can say, political risks. And then operational risk, what you're going to discuss here, operational risks. One is that 75% requirement, which means most of the staff, most of the workers are going to be local. That is fine, but one point which was bothering is it also has limited employment and workplace regulation. So one thing, it doesn't have regulation. So sometimes you might not have proper procedures, proper systems in place. People might not be used to working under proper systems. One thing, okay, if your organization structure, if your way of doing work is under proper systems with proper control measures, how are you going to do it there? Because the people there are not used to that. Second, okay, if you say, okay, we'll adapt the way that the country is running, we will also do the business in the same way, there might be increased risk of accidents, failure of systems. All the risk is going to be there. That can even lead to disruption of operations, disruption of productions. Whereas if you argue, we will bring in, okay, 25% you can bring expats, right? Expatriates. So if you bring foreign workers, can they fit into this environment? Won't there be a cultural difference? Won't there be a difference in the understanding between the local people and the expatriates? How are they going to work together? This seems to be a serious operational risk. How we are going to face this? 1. 2, whether there will be resources, availability of resources. This is assuming resources are there, I discussed this. But will they have trained workforce? Will they have skilled workforce? Whether they can do this? 2. 3, the last part of the paragraph says, these are needed to cope with the increasingly changeable weather and frequent floods. So the company have to keep provision for this as well, increasing weather and the floods in your operations, where the operations are going to be frequently affected by floods, adverse weather conditions. What is the company's plan to face this? Those are operational risks. In the political risk, one more point I have to mention here, the exchange rate fluctuations. Because if the economy is weak, if the economy is struggling, exchange rates might fluctuate frequently. That will have impact on the business as well, positively sometimes, negatively sometimes. Right. So those are the points. If you have any other additional valid points, you can include. I have just included some of the examples. Discuss all these points. And finally, coming to the end, where are we? 4th one. Okay, new subsidiary is the heading. Under that, A, political risk, B, operational risk, we have discussed here. Finally, you are going to come and say conclusion. At the end, you will say conclusion. What are you going to write in the conclusion? This report has analyzed or discussed. So almost same thing in the introduction. You're going to write here as a conclusion. This report discussed this and this. It has analyzed this and this. Done. This is how the structure of the report should look like. Revise this. If you have any doubts, feel free to drop a message, drop a comment under the video. I'm happy to help you. Looking forward to upload some more risk management videos in the future. Please, if it has been useful to you, please share this with your friends and help me to reach more people as well. Thank you.